Robschild, no investment advice. Welcome to the show where we view financial markets using technicals, macro, Ben Graham's investment philosophy, and crystal ball gazing. Today is Monday, October 21st, 2024. Today's episode will start by bringing up the release at 10 a.m. today that came out, the U.S. leading economic indicators for September. The expected was negative 0.3%. The last reading was negative 0.3%, so it was expected to go down another 0.3%, and instead it went down a further negative 0.5%. Going over to the conference board, conference-board.org. This is their website. This is where it's released, right on the website. Anyone can see this. It's public information. The leading economic index shown in blue here is still going down. Now, as you can see, what typically happens is the blue line goes down and then the black line goes down. The black line being the CEI. When this is going down, that means like officially we really, for sure, 100% promise, no lies, we are in a recession. And it is actually still going up here, and very interestingly, which, it can turn over at any time. And soon as it does turn over, that's the recession. But the CEI includes payroll, employment, personal income, less transfer payments, manufacturing, trade sales, and industrial production. But this is just a scary looking chart. The blue line goes down, and then the black line, soon as it peaks and starts to roll over, that's the recession, pretty much every time. To get a longer term view of this chart dating back to 1960, we can go to tradingeconomics.com and see the max view of the value version of this chart of the U.S. leading index, and you can see that this goes down when there's recessions. Not fairly reliably, like 100% reliably. You have the 69-70 recession right here. The next one, the 73 to 75 recession. You have the 81-82 recession, the 90 to 91 recession, the 2001 recession, dot-com bust, the great financial crisis right here, the COVID collapse. Now here, what? This is just collapsing and everything's perfectly fine. If there is somehow a soft landing, I need to see the leading economic indicators going back up. I'm just going to say that flat out. It's still going down, and today's report showed further weakness. Another way to look at the same chart, if you click the change by percent number, it shows if it's declining, if it's going down, or if it's going up. So when it's below zero, whenever this blue line is below zero, it means it's going down. Whenever it's above zero, then it's going up. When it's at zero, it means it's staying flat. So as you can see, every single time we stay solidly below this black line, which represents zero here, there's a recession. There it is, 69, 70, 73, 75, 81, 82. I mean, you get like little tiny dips every once in a while, which are probably little mini crises that come and go. But then you have 90-91 recession, very clear here. The dot-com bust here, all very negative, and the great financial crisis, and then above zero for quite a while. And we have been below zero now since 2022 for 2 years in this. So really, is this a soft landing? You know what? Robschild's going to make a deal with the internet. If this is a soft landing, I will eat my own hat. I'll find a hat and I'll eat it on a YouTube video. I'll do it. I don't think it's possible. I think we're headed into a heck of a storm. But as always, remember, I'm just a guy with a crystal ball, and hopefully a guy that doesn't have to eat his own hat. Before we get to the charts, the second thing I wanted to mention is Thursday we have PMIs coming out and initial jobless claims, two things which could send things rocking or not. Oh wait, I just realized it's Monday. Well, guess what we do on Mondays? That's right, folks. We read through our daily reminders. Daily reminders. 2-year, 10-year Treasury yield curve yields were inverted for more than 2 years, with bull steepening reversion happening in September 6, 2024. This is a huge red flag suggesting we're headed into a bad recession or depression. The SOM rule was triggered in July of this year, 2024. Unemployment is still relatively low at 4.1%, I believe, but it's rising, and that's what caused the SOM rule to be triggered, which normally suggests that the recession is indeed starting. The S&P 500 is sitting still at a PE ratio of 30 without even having major earnings contraction. Major earnings contraction can rise PE ratios, but so can a price that's just going up and up and up and up while earnings are staying flat, and that's what's happening. The S&P 500, the earnings haven't contracted. The price has just gone to the moon, absolute moon. This is an extremely expensive market, historically speaking. Rate cuts began on the 18th of September with a strong 50 basis point cut, suggesting the Fed is fearful here. 2024, we still have 50 basis points more of cuts still priced in. As of the recording of this show, still the 3-month 10-year is actually still inverted. When this uninverts in a bull steepening case, that's when we know for sure that we are now in a recession, and there's no question about it anymore. And it's still inverted right now, so it hasn't actually. We're not 100% sure that it's actually started yet by that metric. But one important thing to point out is that despite the fact that the Fed has been coming out saying we're cutting rates right now because we do not want further weakness in the labor market, they say that on coming out of one side of their mouth, and on the other, they're still restrictive. When the 3-month and the Fed funds rate is above the rest of the curve being massively inverted, it says the Fed is currently still trying to slow down the economy, all while saying they're trying to save the labor market. It's a joke. It does not take a crystal ball to see a bear market coming very soon. I'm also of the belief that the Fed will not cut fast enough to save the economy. And this involves the effect of the amount of fiscal dominance, which happens when you have a lot of excessive debt in an economy. It makes the monetary policies of the central bank of that country less effective. And so while raising rates surprised markets because they weren't as effective to slow the economy down, cutting rates will equally not speed things up as much as the Fed is going to hope. Major storm ahead. Onto some charts. I've been bringing this up a lot lately. I try my best to not be repetitive and bring up things that are less relevant, but this is just so relevant right now for where things are. This is the credit spread between high yield and treasuries. And, while we have all of these indicators screaming at us that there's a huge slowdown coming, credit spreads are really, really, really tight right now. The last reading of this being 2.88. This rarely goes below 3%. This number represents how much more a risky company that is not considered to be investment grade, how much more they have to pay percentage-wise on their bonds, the yields that they have to pay on their bonds. The difference between what the Treasury has to pay, which are guaranteed payments, and very risky companies, which can go bankrupt very easily, actually, because they're not even investment grade. This difference between the spread between yields in major recessions can go as high as 10%, like in the dot-com bubble, or even as high as 20% in the great financial crisis. And right now we are at historic low levels. The market thinks there is zero risk here. There is zero risk priced in to high yield corporate bonds right now. This is why I am holding a bunch of different put contracts on HYG, a junk bond fund. I think it's a great place to be for a speculative way of benefiting from the inevitable downturn. But again, remember, folks, crystal ball. What do I know? SPX, or the S&P 500, the main index of U.S. stocks, near all-time highs, going flat. Mr. Market had a little bit of a dip today. That little tail was kind of nervous looking, and it looks to me just visually like it might want to fall off of a cliff here. So even though Mr. Market is going 100 miles an hour the wrong way down the highway with his empty water bottle with questionable substances in it, the gas tank says it's, pegged on empty, but, who knows how much gas is left in Mr. Market's tank. Does he have enough gas to make it another leg higher or not? I don't know. TLT chart not looking super interesting, but I am bringing it up because if you've been watching the show, I'm very bullish on long duration treasuries. I still have over 50% of my own portfolio in long duration treasuries and leveraged form of treasuries. I'm holding that position for now. Long duration treasury bonds tend to do really well when there's a run to safety, when there's a recession, when there's a big market sell off. You usually get a pretty nice spike. And that's a good time to offload long bonds and go into junk bonds, actually. So that's my whole setup. But anyway, I bring up the chart because it did have a large move down today, 1.75%. This was unexpected for me. I thought that we might have had a bottom here. I'm not worried about it, though. I still love long duration treasury bonds. What might be happening here, because the fact that 20-year and 30-year bonds are not as important in terms of business borrowing, we need to look at what's going on in the 10-year. And the 10-year yield, treasury yield right now, if you look at the similar chart that I bring up a lot, the head and shoulders top on yields, this current view going back to 2022, with just an unbelievable trend line. We have a top from 2021 and then hitting these bottoms here to form the neckline. I'm thinking that Gareth Soloway from Verified Investing, he believes that we are headed up to this 4.38 mark before heading lower in yields. And now, after today's jump in yields, it sure looks like that's exactly what's going to happen here. If I'm lucky enough to see enough weaker data, like for example, if this Thursday, even if initial jobless claims just goes through the roof, and then at the same time, we're at least near this line in yields, I'll be loading up on more leverage on treasury bonds at that point for myself. Again, I think it's important to repeat something that I've brought up before, which is the mismatch between the PE ratio of the S&P 500 and treasury yields. If treasury yields are near zero, then PE ratios can go to the moon, and it actually makes a little bit of sense because of how stocks have to compete with the yields on guaranteed securities, on bonds. Like there's some kind of balance with a 30 PE ratio and rates to be below 1%, but they're at 4%. This is not unbelievably low. The 10-year today's closing yield is 4.18%. So something's got to give, and I'm thinking both things will give. I'm thinking yields will go down, and the stock market will go down. It's like it has to happen. It's like it's so clear in my crystal ball. I don't even need the crystal ball. I can see right through the crystal ball. Moving on, we have XHB Home Builders Index. I have been talking about how surprised I've been at hitting new all-time highs in this. I think this market is getting a little out of control. We had a large red candle to the downside in this today, going down 3%. This obviously has a lot to do with yields going up. So mortgages are, assumed to become more expensive, making it harder for home prices to stay as high, making the profitability of home builders to be squeezed. I'll note that this is also like really kind of crazy to me that we're basically at all-time highs in home builders. So it would make sense for this market to get really bearish, but right now it's near all-time highs. It was interesting seeing. I've been talking about the dollar lately and how unbelievably strong the dollar had been getting, and how we finally had a red candle day, and today we popped right back into this trend. It's like dollar to the moon, I guess. Again, like it doesn't really make sense here with gold and Bitcoin and all these other things being in so high valuation while the dollar is ripping higher and nothing's dropping. This is a mismatch, and it's gonna correct. This can't go on forever. It's not possible. So this is very interesting, the dollar going up right now. Speaking of Bitcoin, whenever I try to judge what's going on in the charts in Bitcoin, I'm very thankful that I have Gareth Soloway to listen to from Verified Investing. He's just amazing with all of his experience. Officially on Sunday, I said on Friday, it would be interesting if on Sunday we got that confirming candle. And guess what? That's exactly what happened. We closed above the wick of Friday's candle. Now, normally, according to good charting, that would be a confirmation signal that Bitcoin is about to go up. The next resistance level, everyone's saying, is like 74, 75,000. And then above that, I think it's all the way up to 100,000. But one thing that he brought up, I think, is worthy of knowing, is that on Sunday specifically, the volume was really low. And so whenever you have very low volume days, you have to take the market action with a humongous grain of salt. And if you did take it with a humongous grain of salt, you got lucky, because today was a pretty good flush, actually, in Bitcoin from Sunday's action. Gareth's prediction here, he thinks that the institutions are trying to convince people that Bitcoin's going to go up, and they're trying to get as many people on board before it flushes out. Overall, I think he's bearish on Bitcoin. I have been considering getting into miners here, especially because, why not ride the wave from 70,000 to 100,000? The miners will go to the moon when that occurs. But maybe better stay away from this for now. I have better, safer speculative positions. This is the thing. With the FOMO thing, there's always another trade. There's always another thing that you can do out there. There's no issue just waiting for something that becomes just blatantly obvious. And, as I've said on the show before as well, I'm not a momentum trader. I don't like chasing things to new highs in general. And so, I'll probably stay out of this unless maybe if we close above 75,000 or something, ride it to the 100 mark at this point. Wood, one of my favorite leading indicators, still cooling off here. Pretty good down day with this bearish red candle. Finally, probably the most important chart of the day is the semiconductor ETF. By the way, if you look at the map of all of the different stocks of like what's going up and what's going down, the only thing that's holding the market together right now is Nvidia by itself. Pretty much all stocks got sold off today except for Nvidia, and yet the S&P 500 went flat because of Nvidia going up something like 3% today by itself. So the semiconductor industry, the ETF, the chart, what's going on here. This is the most important chart to me right now. And it's not looking bullish at all. We're still inside this large engulfing red candle. These are all inside days. If anything, this is sort of forming a flag-like pattern, suggesting that very strongly that this is going to go down. It looks, and then, zooming out, if this head and shoulders pattern plays out that I've been talking about for months and months now, to the downside, if we crack that neckline, watch out below. Again, this can easily lose 50%. There is so much speculation and hype priced into AI and semiconductors. Nothing goes, I just heard a recent adage, trees don't grow to the moon or something like that. They don't grow forever. They can grow real tall. They can get real big, but they don't grow forever. And when you have an enormous amount of speculation priced into the company, when people are paying an enormous amount of money for a very tiny, return that the company is actually making in profits, as soon as people realize, oh, wait, you mean their growth, the growth earning isn't going to be doubling every year for the next, 20 years, the ride down can be a very fast one. You can have a company like Nvidia change its price as if it's a penny stock, and I'm not exaggerating. The Qs, or the NASDAQ, tech stocks themselves having the same exact structure as the semiconductor industry ETF. My way of playing this, I do have SOXS. It's a triple leveraged short fund of semiconductors, and I think that's a wonderful speculative place to be, see how it plays out. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.